Welcome, everyone. Thank you for joining us. Without further ado, it is my pleasure to introduce Catherine Avery. She's the founder of Catherine Avery Investment Management, which she started in 2007. Ms. Avery has been successfully managing client assets at major institutions and in her own firm for over 30 years. Her investment career and credentials are broad, as she has worked with several leading investment firms in the U.S., including Morgan Stanley, Shearson Lehman Hutton, Prudential Securities, and Merrill Lynch. Ms. Avery also has a vast portfolio management experience spanning a wide range of asset classes. Now, to our live viewers, please type any questions you may have for Ms. Avery in the chat box. Time permitting, I will announce those questions at the end of her presentation. And with that said, Catherine, I'll be right here if you need anything, and the floor is all yours.
Great. Thank you, Shelley. And thank you, everybody, for tuning in. I know that there's nothing more near and dear to people's hearts than trying to be able to have a successful retirement. But I think it's important that we try to put into context, where we are today and where we need to get individuals' portfolios to be. Last year, 2022, not an easy year for investing. It was one of those years where we saw the fastest pace of rate hikes in history. Inflation was surging to record levels, and probably those days of low interest rates are well behind us and maybe not ever seen again in our lifetime. And the market took a big hit last year. The S&P 500 in a broad sense was down 18%, but I know that for many people in their investment portfolios, it was a lot worse than that. Some of them 20%, some of them 30%. And many people were looking forward to saying goodbye to 2022. And here we are, 2023. And the question is this going to be a difficult year as well? So far in 2023, it seems like we're off to the races. The S&P is up this year. But at the same time, is inflation declining? Yes, it is, but it's declining very slowly. Is the Fed done yet? Nobody really knows. I mean, we had, last month we had what we would call a dovish hike. The Fed raised rates last month. They were saying that inflation was coming down, but they still said there was more work that needed to be done. Yesterday, we had the opposite of that. We had what we call a hawkish pause, where the Fed said we're going to stop for 1 month, but we may not be done yet. Because we still see strong labor markets. We still see that some of that inflation out there is very sticky. And at the same time, as the market has gone up so far this year, the valuations are going up. And that's a problem because during high interest rate environments, or as interest rates rise, the amount of money that we pay for stocks is a lot less. So just going to our next slide here. In the first part of this year, there was really no breath in the market. There was maybe the top 5 stocks were driving the overall S&P 500. So if you didn't own those top 5 stocks, you didn't really feel like you were participating in the market. And a lot of those names were in the technology space. And the valuations on those stocks are now trading at about 30 times. The market overall itself is probably about 19 times, but still a lot higher than what we would normally expect in a higher interest rate environment. And one of the things that we're really concerned about is this differential between what the Fed's saying is going to happen with interest rates and what the market or investors are expecting is going to happen. This is what we call the Fed dot plot, and we get this every month. I'm sorry I didn't have a chance to update it as of yesterday, but the directional is still correct, okay? The Fed is basically saying that interest rates are going to continue to go up further before they go down. And the market is actually saying, no, we're expecting cuts in the interest rates this year. And what happens is this really causes a lot of angst, not only for the markets, but for investors as well, in trying to manage their expectations. Because as you get into retirement, one of the things that you really are looking for, you're looking to use your investable assets as sources of income to help you with your lifestyle and meet your monthly bills. And so, with the fact that, inflation might be coming down, we're also starting to see that there's a lot of lags in different areas of inflation. And I happened to pull out in this chart medical care specifically because I wanted you to see what's happening with that sector in terms of pricing over a longer term period of time. So we have the CPI coming down this year, but medical costs are not really coming down. And one of the biggest costs that we have in retiring is looking to stay healthy, maintain that health, and address any health problems that we may have. And this has been pretty consistent even as we go back to the financial crisis. So if you look at March of 2009, you're still going to see that the green line, which is over here, is still well above the red line, which is the overall inflation rate. So medical costs remained higher than the overall rate of inflation much of the time, through until we got into the COVID situation where people just weren't going and having health procedures. But as that starts to pick up again, people are going back for medical procedures. Taking care of their health has become another priority for them. We're seeing that the medical costs are continuing to go up. So the point, what I'm trying to say here is that even though inflation on the headlines might be coming down, the things that retirees really need to sustain their retirement may not always be going down. So that's why it's really important that we strengthen and protect these portfolios during retirement. And we'll also talk about why we should think about strengthening and protecting the portfolio several years before we even get into the retirement phase. At the end of the day, clients, because we're all living longer and because we have these inflation bouts that are unpredictable, we need our money to work harder than ever. We need to protect our purchasing power. In order to do that, our money has to earn rates greater than that of inflation so that we do not run out of money. We need to stay ahead of inflation. And I think that dividends are the answer to this. And we'll see why. And it's not just any dividends, but very, very specific types of companies that pay dividends. A lot of people think that as they get into retirement, they need to adjust their portfolio to become more conservative, have more bonds in the portfolio. But the problem with bonds are twofold. Number one, they don't help you stay ahead of inflation. You buy a bond at par or preferably a discount to par. And for the life of that bond, it pays you an interest rate, but that interest rate stays the same the entire maturity of the bond. And then when it matures, you get your principal back. So there's no gain in appreciation on the bond, and there's no increases throughout that life cycle of the interest rate. It stays the same. So by the time that bond matures, you've basically reduced your purchasing power. And then add on top of that the interest from bonds is actually taxed at ordinary rates, while dividends are taxed at a 20% rate. And that's qualified dividends. And we have to really make sure that we have that distinction, because a lot of people think if they buy higher yielding securities like MLPs and REITs, that helps to suffice, but portions of those dividends are actually taxed at your ordinary rate because they are considered to be non-qualified. So the dividends actually provide consistency and predictability of an income stream, right? There's nothing worse than being in a market environment where it's down 20% and your $1 million portfolio goes from $1 million down to $800,000 because the market is down 20%. In that sort of a case, now you're forced to sell stocks at a lower price. Nobody wants to do that. So this is all about how we strengthen and protect that portfolio, and how do we get some sort of consistency and element of certainty into the investment process to make it more comfortable to retire and helping you to stay ahead of the inflation. So even if we're in periods where clients are not using that dividend to supplement their income, to pull it out as cash, in those years pre-retirement, you can use that money to buy more stock. And it's that compounding effect that really makes a huge difference. And you're able to buy stock at much lower prices. Most people don't really realize this, but historically, dividends have contributed more than 50% to the total return of a portfolio. If you go back and you look at from the 1930s all the way through to the 1970s, it was anywhere between 44% to greater than 100% that the dividends represented of that total return. And it wasn't really until we got into the 1980s and then into the 1990s where people started talking about stock buybacks, and that was a thing. Nobody wants to pay dividends anymore. The markets were doing great. In the 1990s, if your portfolio wasn't earning at least 25, 30%, somebody was doing something wrong. It was all about the alpha generation in the portfolio. And then unfortunately comes the 2000s, that dot-com bubble burst, and we went back into a period again where dividends actually really mattered for the portfolio. From the years of 2000 to 2010, that's one of the worst years in history for stock prices. But if you look at this chart, you'll see that dividends returned about 33% to clients in their portfolios during that period of time. And it represented a greater than 100% of the return because the actual return on the price of the stocks was negative. And one of the things I want to point out is that as we are coming into this, as we are in this period of higher interest rates, it's probable that we don't go back to zero interest rate environments again. And I think a lot of that has to do with demographics and globalization, deglobalization, lots of other secular factors going on. But I think we have to brace ourselves for a couple years or at least another decade where we're not going to see 0% interest rates. And during that period of time, you find more of a normalization in equity returns. So thinking a little bit more along the lines of anywhere between 6 to 10% annualized, give or take the year, and with that 6 to 10% annualized return in stocks, a large portion of that coming from dividend payments. The magic of compounding. Albert Einstein actually said that compound interest is the eighth wonder of the world. And I think he was possibly right. We hear about this all the time. People talk about it, but I think a lot of times we get caught up so much in the day-to-day of what's going on in the markets, the excitement of stocks going up, excitement of stocks going down, that we really forget is that there's this very consistent, slow, steady way for people to invest their money. And this can help definitely provide some sort of stability in the overall portfolios and provide a return for the clients, even in the absence of no return. But I want to caution people, not every dividend stock is created equal. We do have to take several other factors into consideration. And I think it's this combination of growth, quality, and yield that really gives that total protection, that lower volatility, the stability, not only of the stock price, but also of the income stream in the portfolio, which is really what retirees need. And when we talk about growth, we're talking about growth in dividends, okay? Everybody wants to see that the dividend price, the dividend per share is increasing at rates greater than inflation on an overall basis. And we also want to see growth in earnings per share, right? We want companies that are able to grow their earnings, because as they grow their earnings, then we're also able to see appreciation in the stock price as well. Quality is going to be key. We want companies that have quality balance sheets, quality managements, quality products and services. Yield is also going to matter. Looking at companies that have dividend yields greater than or equal to the overall market. And more importantly, companies that have free cash flow yields greater than the dividend yield, because it's the free cash flow yield that really gives us an insight into what is happening with that company and whether or not it has the ability to sustain that dividend and increase it as well. I'm often told, well, when you buy dividend stocks, you just buy, stocks like GE, for example. And I said, well, Actually, no, we don't just buy stocks like GE, because if you take a look at what's happened to GE over time, you probably want to run as fast as you can in the other direction. GE was one of those stocks that was one of the market darlings for the 80s and the 90s. You know, the stock price kept going up. It seems like it was never going to end. It had a wonderful dividend. It increased their dividend, and then came the 2000s, and something happened with that company, and it just completely fell apart. A lot of worms started coming out of the woodwork with what was going on with their accounting. The company was on the verge of bankruptcy. It had to spin off many units, and it cut their dividend. Poof, the dividend was gone. So it's important that you don't just, as I like to call it, park and pray. Just say, well, I'm just going to go look up any old company that pays a dividend online. That dividend looks kind of good. I'll just keep it and hold it in there and forget about it. Not how it works. We also had a similar situation a few years ago with Boeing. Boeing was a phenomenal company, great cash flow story, great products and services. And then something happened with the Dreamliner. As we all know, they did not do enough of the testing with the FAA, and there were several crashes, and it really hit the stock badly for many years. Luckily for us, we owned Boeing at a very low price. We got out of the stock as close as possible to the top, but we started to see that as this Dreamliner was coming offline, that cash flow of the company was going to be decimated. And decimated it was, along with the stock price, it's now starting to recover a little bit, but still no resumption of dividend. The dividend was completely obliterated. So I would take a little bit of caution and really understanding what it is that you own in the portfolio. The KM portfolio that we manage here currently has a dividend yield of about 3.9%. The S&P 500 is at 1.6%, so way more than double that of the S&P 500. And the 10-year Treasury is about 3.78% as of right now. So still a little bit higher than the 10-year Treasury. But remember, in a long duration asset like the 10-year Treasury, that there's no increases in that 3.78%, but you will see increases in the dividend portfolio that we have here at KM. So that's why it's important. I want people to know that it's not just about higher dividends and dividend growth. It's about the two. The two when they marry together really become part of that, as I would say, that secret ingredient to giving that stability and protection for clients in their retirement. And just to give you an example, here's just a sampling of some of these stocks in the portfolio. These are stocks that are yielding well over 4% in the portfolio. And in addition to these stocks yielding over 4%, a lot of them had significant dividend increases last year and as we come into this year. And it's important that the dividend increases, again, as I said before, stay well ahead of inflation. And the way we look at that and the way we determine and whether that can continue to happen is between looking at those three variables: the growth, the yield, the quality of the company. We had two really great dividend increases in our portfolio in the last year-over-year time period. Ford increased their dividend by 50%, Oracle by 25%, in addition to being, a phenomenal stock for us this year. But I want to the way you really see how this works is by going through a live account. So this is an account of one of our clients here at KM. The client does have several accounts with us, but this happens to be her IRA rollover account from a firm that she used to work at, and she sent over to us, and then she went into her own business. So since 2014, what I liked about this account, why I chose this account, even though to some people it may seem like a small amount of money, is the fact that it's a very clean account. So there were no contributions and no withdrawals. And I wanted that because that way you really get to see how that compounding of the income stream really works. I didn't want to have anything that kind of messed up the numbers in terms of adding to stocks and then having to pull that out. It's a very, very clean account. And you can see as the account started in the year end of 2013, 237,000, and the stock is now worth over 500,000. So yes, we've had some very good years in the market, but we also had some years in there that were not so great. If you take a look at 2015, the portfolio was actually down 2.75%. But from 2014 to 2015, the dividend income grew by 13%. So you started out at 6,000 in 2014, 2015, the clients now have an income stream of 7,000. And the same thing happened in 2018. The overall portfolio may have been down, but guess what? The dividend income stream still grew by 9% from the previous year. And from 2014 to 2022, the dividend income stream on this portfolio has more than doubled in a 7-year period of time. And this is what we're talking about. Clients need something in their portfolio, especially during their retirement years, where they can say, I can pretty much count on this with a higher level of certainty. As I said before, nobody wants to take money out of their portfolio when they have $1 million portfolio that's gone down to $800,000. It's down 20%. Nobody wants to take money out of their portfolio when the portfolio is going down. But here you can see in this instance, even though the portfolio had periods when it went down, that dividend income still continued to grow. Now, this client will probably not retire for another 5 or 7 years. And this is why it's important to think about starting this type of an investment philosophy, investment process, whatever you'd like to call it, as early as possible because of that compounding effect. Again, in less than 7-year period of time, this dividend income stream has doubled. If she can wait another 7 years to retire, this will most likely continue to grow and double to more than 36,000 a year. I like this graph because it actually shows that progression year over year. If you annualized out the increases from year to year, from 2014 to 2022, you come out with a compound annual growth rate of about 12.5%. That's huge, and that's well ahead of inflation. And even though we think that inflation is going to be heading downward, we do know that we'll still be able to get these dividend increases because we look at these companies that are so flush with cash. Sometimes people say to me, well, I really don't want to own individual stocks. I'd much rather prefer to own an ETF or a mutual fund. And that's great, but I will tell you, you don't get the same benefit in this type of a discipline by owning an ETF. It's definitely much more important to own the individual stocks for a couple of reasons. So this chart here shows the KM year-over-year dividend growth against the VIG, which is the Vanguard Dividend Appreciation Fund, and the DVY, which is the Dow Jones Dividend Select ETF. And I chose those two ETFs because they're kind of polar opposites. If you remember, I said before, not all dividend disciplines and processes are the same. You will mostly find out there that a firm will either focus on dividend growth, which is the VIG, or higher dividend yields, which is the DVY. And when you buy an ETF, you do not necessarily get the exact yield of the underlying stocks in the portfolio. The yield for an ETF or a mutual fund is set by the mutual fund company. So while the KM portfolio is averaging about 3.9%, the VIG is only at about 1.5%, and the DVY is in the low 3s. And that will change year over year. And you can also see if you look at the bars in this chart, that there's a lot of differential from year to year and what they're able to return. And actually in 1 year, the VIG in 2016, the dividend growth from 1 year to the next was actually negative. And the same thing, for DVY from December of 2019 to December of 2020, there was very, very little increase in the dividend yield, in the dividend growth of the portfolio. So, what I like to say is when you own an ETF or a mutual fund, especially if it's passive, you kind of get the good, the bad, and the ugly. Okay. So, you're not getting enough consistency in the attributes of that growth, quality, and yield throughout any one specific fund. Whereas in a customized portfolio, and we can even have clients who come to us directly and say, hey, look, that 3.9% dividend yield is great, but is there any way that you can help maybe push that up a little bit for us so that we can get a little bit more income out of the portfolio? So this is a little bit of an example of how we get to some of the stocks in the portfolio that we own. We call them dividend champs, and we call them dividend champs for a reason, is because they've got 100% across the board all the ingredients that we look for in a company that we want to have in the portfolio. The first one is a company called Oracle. They're a software company. Oracle has a 1.7% dividend yield, greater than that of the S&P 500. Its free cash flow yield is higher than its dividend yield, which gives us, and matter of fact, if I remember, I showed you before in the original graph, they increased their dividend 25% this year, and that's because they have the ability in their free cash flow to do that. And at the same time, they're trading at a valuation less than the overall market. CVS is another dividend champ for us. They increased their dividend by 10% this year. Free cash flow yield, 10.9%, triple that of the dividend yield. So that even though they increased their dividend by 10% this year, it's a pretty good darn chance that they're probably going to increase it around another 10% next year. I'll take 10% dividend yield increases any day, all day long. And the stock has a lower PE of 8.4%. So, we're looking for companies, again, with that magic, above average dividend yield compared to the market, higher free cash flow yields, higher dividend growth than the inflation rate, and at the same time, trading at valuation levels a lot lower than the market. And the last one on our list here that we show is Chevron, 3.6% dividend yield, free cash flow yield, again, triple that of the dividend yield, which gives us a lot of confidence that the dividend will be able to be increased year over year, and dividend growth of 6%, ahead of inflation for this year. And, this is what we feel is the recipe for being able to give clients that ability to have some comfort level and have that ability to be able to increase that dividend and stay well ahead of inflation and not run out of money during your retirement period of time. This is just an annualized performance for CAM. Last year, as I said, most people were talking about large losses in their portfolio. We were actually flat after fees. We won several awards for our performance last year, so we're very proud of that. And I just want to say, in summary, this is an investment process that basically benefits clients in both up and down markets. When the market's going up, it's great to have the stock prices go up and you have the dividend. There's nothing better than having cash in your pocket. And when the market's down, even though the market's down, the clients are still getting that dividend income into the portfolio. They say cash is clean, and it's king, and it's something that's very, very tangible for clients and really helps them to stay ahead and protect their portfolio. We think that dividends are the answer. Again, it's that predictability and consistency of that income stream. And, it gives clients a lot of flexibility and control. Nobody wants to run out of money, and nobody wants to hear that they have to pull out money out of their portfolio when the market is down. And then lastly, this contributes to both, aiding and abetting, aiding a, lower overall volatility in the portfolio. And we do feel that it's really important to have not only the growth, but also a little bit of an above average yield in the portfolio. That marrying those two together is really key. So I'm going to leave it with that and open it up to any questions that people may have. These are all our disclosures. If anybody wants to contact us, here's our contact information. Feel free to call us or send me an email at caimllc.com. I'm happy to talk to anyone and help you out. Thank you so much.
Great, thank you. That does conclude the time for this session. I want to thank you all again for joining us, and thank you, Catherine, for your awesome presentation.
Thank you, Shelley.